Inspired Michiana. I'm Diane Bennett with Inspired Homes in both Michigan and Indiana, and you are watching Tuesday Tips. Today we are at Notre Dame Federal Credit Union, and we're going to be talking to Stephanie Williamson, who is helping our very own Trina Uslick, who's buying her first home. And we're going to find out what Stephanie has to tell Trina about how to buy her first home. So let's take a look. So here we are at Notre Dame Federal Credit Union, and this is Stephanie Williamson. And
Hello.
So, yep, we're going to ask Stephanie some questions for Trina about what she needs to do for her first loan, getting her first house. So,
Awesome.
What would you tell Trina or any of our viewers?
Yeah, well, it's a very exciting process. Here at Notre Dame Federal Credit Union, we try and keep it very easy and simple. I always tell borrowers that the biggest part, most time-consuming actually, of the financing process is just the beginning steps, getting all the paperwork around, submitting the application.
Right.
Exactly.
Yeah.
But we try and keep it simple here. Honestly, so it kind of depends on what you're actually looking for. So down payment, that's generally the one thing you need to start thinking about first. Is generally 3% is a minimum down requirement.
Okay.
And it varies. I mean, the more you have, the better it is. Down payments can come from obviously just saving it up. It can actually come from a family member as well.
Yeah, tell her about gift funds. We
Yeah.
haven't asked about gift funds.
So gift funds, they can come from a family member, so grandparent, brother, sister, parent, something like that. They're able to gift you the funds for your down payment, which is phenomenal.
Okay. And don't they have to write a letter?
Yeah, it's a letter. Your lender can provide that to you. We have just a generic letter that we can use for that, which is great. Beyond that, the next portion is credit. So it depends on what you have for credit so far. If you haven't started, now is a good time to start. It usually takes about a year or two to actually build up a good, strong credit score.
Yeah.
And lenders usually like to see 2 or 3 types of lines of credit in order to do a mortgage loan for you. So that could include a credit card, an auto loan, maybe a personal loan, just with good payment history.
Okay.
Now for, I believe, down payment, well, we already talked about down payment. As far as mortgage payment, have you sat down and set up a budget, what would be comfortable for you?
Yeah, John has done that more so than I have. He's much more of the get the numbers together and, that kind of thing.
Yeah.
So yes and no.
Okay, no, that's totally fine. So to give you an estimate, usually your mortgage payment should be, if you look at your gross weekly income, so 1 week's wage, that's about what your mortgage payment should be, or what you should be comfortable with.
Okay.
So I just did some quick figures. Using say if you make $30,000 a year, your monthly payment that you would want to look for your mortgage payment wouldn't be any more than $815. Of course, you can obviously go less. You can probably go slightly more, but that's a rough estimate for you.
Gotcha.
Beyond that, are you familiar with what includes your monthly mortgage payment?
No.
Great. Awesome. Okay, so with a monthly mortgage payment, you have several different things. You have your payment, your principal portion, your interest portion, and then you have your escrow account, and that is your taxes and insurance. So in a mortgage payment, your lender will escrow for your taxes and insurance. Then the last portion is the private mortgage insurance. It's also referred to as PMI insurance. And with that is anytime you don't have 20% down or more on a mortgage, that's when this insurance comes into play. So that would be a portion of that as well. So I ran a quick calculation. Say if you wanted to buy a house for $100,000, you have 3% down with the payment and principal portion, taxes and insurance, and the PMI. Your total monthly payment would be about $720.
At
At a $100,000 house.
well, okay, gotcha.
Yeah. Now, and I'm sorry, that would be for a 30-year fixed conventional loan.
Okay.
So we offer here at Notre Dame Federal Credit Union, we offer conventional loans, FHA loans. We also have several specialty loans that we also offer too for certain borrowers depending on the situation. But beyond that, that's about that's a good rough estimate. A lot of first-time home buyers, they go with a 30-year fixed mortgage simply because you don't really want to have to worry about interest rates, increasing over the life of the loan. So that's generally what we recommend.
And I know John was also wondering about what's the difference between a 15-year, a 20-year, a 30-year, a 40-year. Why would they pick one of those?
Yeah. So, I mean, the lower the term, the better it is for the borrower. So, I mean, it depends on what you're comfortable with. 15-year term, you're probably going to pay actually the least in loan fees as well. And obviously it's an accelerated schedule compared to a 30-year. So you're going to be, I mean, that's 15 years less that you're going to be borrowing from the bank for interest. So the interest, how much you'll pay in interest will literally cut in half. If not more.
Okay.
Which is
because
phenomenal.
you've only paid it off in 15 years instead of 30 years.
Instead of 30, right.
Yeah. So sometimes what borrowers do also is they take out a 30-year loan and have it and make their own payment schedule and pay extra to the monthly principal of the loan, so then they pay it off in 15
So do you
years.
typically recommend, like, so let's just say the loan payment was $1,200 a month?
Yeah.
Or maybe that the principal and interest is $1,200 a month, and then every single month they pay $100 more, so they've made 13 payments after a year instead of 12 payments after a year. And that pretty much, doesn't it cut like 7 years off the loan?
Yes. Yeah, absolutely. That would be a phenomenal, I mean, anytime you can put anything additional to the principal of the loan will significantly decrease the term and what you're going to be paying in interest over the life of the loan.
So then doing something like that, why would somebody want to choose the 15-year loan? Why not go with the 30-year loan and then just make extra payments?
They totally
to
could.
do the 15 years.
And someone like you, I would totally recommend that. Some people are just like, oh yeah, no, I want to be done. Just put it on 15 years. And they know they've got plenty of money and they can.
Gotcha.
They can make because it's going to be, your payments are higher at 15 years than
right.
they are.
Well, yeah.
Right. You know, and so if you need more time so that payment's lower, but you can do higher, that's the safest way for someone in your shoes to go.
Right. Okay.
So.
Because then that also leaves you still got your minimum payment that's lower, and so if you need to, like, your refrigerator breaks down or you need to get a new car, like, you have the extra money monthly to do that.
Exactly right.
Okay.
Yeah, you got it.
And another good thing to think about too is there is something called the closing cost portion of the loan. So there are some fees in getting actual a mortgage loan. You've got the lender fee, so how much that we have to pay to get your appraisal. There's also title work charges in there too. So typically those charges can run anywhere from $1,500 to $2,500 depending on where it is. But the great thing is those a lot of the times can be rolled into, the seller can actually pay for those. So with your realtor, as long you want to get a good experienced realtor which I know Inspired Homes, they do obviously have that there. They can write that into there, into the contract. So that would also help with lowering the amount that you have to actually bring to closing.
So, and I will tell you too, like, let's just say you're going to buy a $100,000 house and you're going to ask for $2,500 in closing cost assistance. Well, that's really for the seller only an offer of $97,500, right? So in there, even though you're writing in the purchase agreement, it says $100,000.
Gotcha.
And you're offering them $100,000, and you feel like you're paying $100,000. If you're asking them to pay your closing costs for you, that's less money in their pocket at the end. So to the seller, it feels like lower. So what happens if you're in one of these houses that has a bidding war and you have competition? You have to remember, oh, well, I'm asking for closing cost assistance, so maybe I better offer $105,000, which to them is really $102,500. And so maybe I'll beat the other person that's offering $100,000.
Right.
Okay. So yeah. Okay. So those are things to think about.
Absolutely. Any questions can you think about for me?
I don't know. We covered. Yeah, we
talked
covered
a lot.
Yeah.
Awesome.
So
I'm a quick talker, so if you have any other questions in the future, just please give me a call. I'd be happy to assist.
Absolutely.
Right.
Well,
Awesome.
Facebook, thank you so much for watching. If you've got other questions for Stephanie Williamson at Notre Dame Federal Credit Union, we will hook you up. So just message us here, and we'll let you know. So thanks for watching Facebook. You guys have a great day.
Thanks so
Bye-bye.
much.